One is that for the past 40 years, the United States has had, and most of the developed world, has had rising debt as a percentage of GDP, public, but falling interest rates. And so if you double your debt levels, but you cut your interest rates in half, your interest expense is still manageable. It hasn't changed. Now is that when you bounce off zero and you start going sideways to up, that interest expense actually starts to matter. And so we're kind of in this phase where for 30 years, you could kind of ignore the public debt. And now it's getting to a point where you can't really ignore it, and it's one of the sources of inflation.
In recent years, the United States debt situation has worsened, prompting widespread concern from both the public and prominent investors. Even the International Monetary Fund has taken notice, with a senior IMF official warning that the Treasury debt market faces extremely adverse conditions, attributing this to an unsustainable fiscal path in the U.S. Victor Gasper, director of the IMF's Fiscal Affairs Department, noted that U.S. deficits are high and expected to persist, with unfavorable debt dynamics under current policies. The United States is predicted to experience a fiscal deficit of around 6% of its gross domestic product this year, despite a growing economy and low unemployment. The Congressional Budget Office anticipates these deficits to persist over the coming decade. During the 2023 fiscal year, the U.S. government spent $6.131 trillion while generating about $4.441 trillion in taxes and other revenues, resulting in a deficit of approximately $1.7 trillion, $300 billion more than the previous fiscal year. Macro analyst Lyn Alden emphasized the increasing urgency of the U.S. debt situation in 2023. While the debt problem has been recognized since the 1980s, Alden noted that past economic resilience was due to rapid globalization and a relatively peaceful period. However, this stability has been disrupted, and the reliance on similar rapid development and global peace is no longer a viable strategy.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The overall long-term views are generally unchanged. These things, while individually unpredictable, tend to happen more frequently when we're in the environment that we're already in. So one way to think about it is that, sovereign debt crisis leads to war and inflation. War and inflation lead to sovereign debt crisis. It's kind of this feedback loop until you get to the next epoch. Another way of putting it is that inflation leads to disorganization. Disorganization leads to inflation. And so there's two kind of major themes I track at the current time that are tied directly together. So one is that for the past 40 years, the United States has had, and most of the developed world, has had rising debt as a percentage of GDP, public, but falling interest rates. And so if you double your debt levels, but you cut your interest rates in half, your interest expense is still manageable. It hasn't changed. And so especially in this kind of the past 30 years or so, they've had that sharply falling interest rates. And the problem now is that when you bounce off zero and you start going sideways to up, that interest expense actually starts to matter. And so we're kind of in this phase where for 30 years, you could kind of ignore the public debt. And now it's getting to a point where you can't really ignore it. And it's one of the sources of inflation, along with other things. That's kind of one of the demand movers of inflation, or just like a debasement mover of inflation. And so that's number one. Number two is the geopolitical aspect, and it ties into that because, if you look at a long-term chart of public interest expense, it was sharply rising throughout the 70s, 80s, and that was kind of the peak time when people got concerned about the debt. So the national debt clock went up in the late 1980s. And some of the early elections in the 1990s, you had major candidates like Ross Perot that were really kind of putting focus on the debt. It kind of hit a crescendo there, and they kind of got they marked almost a top because with the opening of China and with the fall of the Soviet Union, it kind of opened this big period of disinflation. So you basically brought Western capital together with Eastern labor. And so you build up all these Eastern, Asian manufacturing facilities. You connected cheap Russian gas to Europe, and these were boosts of productivity, boosts of abundance, and disinflationary. And so a lot of those debt problems fell away, and people said, debt doesn't matter. Those people were, calling wolf, and for about 30 years that was correct. And the problem now is that mathematically, when you run into zero rate and then bounce off of zero, and when you've kind of exhausted those 30 years of like a peace dividend. And now we're entering a more fragmented world. So the U.S. and China more rivals now. Obviously, what's happening, with Russia's invasion of Ukraine and now Israel, some of these ties that have been, more solidified over the past 30 plus years are less so. And so the combination of having public interest expense actually become a problem, mixed with more challenges on the supply side, which can feed on themselves. I think that's setting up a more, on average, inflationary decade, and on average, a less energy secure decade. So higher average energy prices, risks of energy volatility. Um, and so I think that's what we're kind of optimizing for, at least from my perspective. To the extent that things changed in the past week, um, I think that I've been a bond bear since 2019, and the nominal drawdown on bonds was surprising even for me, even as a bond bear. I think that tips are starting to get a little bit more interesting from the long side. If you wanted to say rotate a little bit of capital out of, say, the Magnificent Seven equities that have just kind of gone only up, and I think that some of those, I'm not exactly a buyer of bonds in general, but I do find that the tips real yield to start being somewhat interesting.
Mm.
And also, if we do start to see kind of a stabilization in real yields, that's also what helps give gold and other types of assets some real legs.
Treasury inflation protected securities are financial instruments that have their principal value linked to the consumer price index. When inflation occurs, the principal value of TIPS increases, and conversely, it decreases during periods of deflation. Upon maturity, or when the security is sold, the U.S. Treasury pays the investor the higher of the original principal, or the adjusted principal value. In the current uncertain market and economic conditions, Alden suggests that some investment choices may seem counterintuitive. However, she endorses investments in TIPS, select real estate assets, and long-term assets resistant to market upheavals, such as Bitcoin and gold. This seasoned financial and macro analyst contends that those who have already diversified their investments into tangible assets like Bitcoin need not be overly concerned during turbulent times. Let's return to the interview.
For the next 6+ months, a key thing I'm watching is, so right now we have this very, kind of loose fiscal environment, but obviously you have the tighter Fed environment. They're doing their best, as Chris mentioned, to slow down demand, to try to modulate what's happening. And so one thing we have to look at is how long can they maintain this? Because combination of a strong dollar, rising yields, and high energy prices does put a lot of downward pressure on the world economy. It does put downward pressure on the domestic economy. And the question is, who's going to buy all of that massive treasury issuance? So the Fed's not buying, banks are not buying, the foreign sector is not buying. Really, the only place to absorb it is domestic non-banks, and they have limited overall balance sheet capacity. And so right now, the Federal Reserve is drawing down their balance sheet, but they're also, the reverse repo facility is drawing down. And as that draws down, that actually pushes liquidity back into the financial system. And so that's been happening at a roughly equal pace. And so ever since the banking crisis earlier this year, overall domestic liquidity has been roughly flat. And the reverse repo probably has about 8 months more or so before it would be drawn down at the current pace. And I think after that, we start to get interesting questions like, can the Fed still be as tight as they are in the face of so much fiscal issuance? And I think that's where we might get more of a regime change outside of this kind of current environment. But right now, as long as the Fed's drawing down their balance sheet, I think a more risk-off type of outlook makes sense. The size of the fiscal deficits as a percentage of GDP outside of recession or direct war are rather unprecedented. That's
Right.
what kind of feeds into this, what I would call kind of the early signs of basically a sovereign debt crisis. And so again, a lot of the biggest buyers are essentially leveraged, like banks, the Fed, right? They can buy very large amounts when they're buying,
Mm.
because they're not buying with finite balance sheet capacity.
Right.
The problem is that the remaining buyers, even if they do have a somewhat risk-off stance, um, they're buying with finite capacity. In addition, a lot of people are momentum traders, so when they see just bonds constantly going down, uh, they tend to get on one side of the boat. And so that's why I'm starting to mention that after this drawdown, I do think we could see a little bit of rotation here back into bonds. And
Right.
my preferred risk way to play that is the tips, because if I'm concerned about energy prices,
Hmm.
um, I'm less inclined to go with the nominal bonds, even though I think you could certainly have a tradable bottom with them. But when we look at the huge amount of supply coming to market with some of the stagflationary concerns I have, I still don't love the nominal trade for the bonds, but I do think that the tips are getting interesting, and I do think that if this much issuance keeps coming to market, the Fed keeps holding their situation tight, at least for the maybe next 8 months, the risk reward for the say S&P is just not particularly attractive, and that's different than necessarily saying a hard landing. I mean,
Mm,
if the S&P 500 goes sideways for a year and T-bills pay you 5%, your hurdle rate is no longer zero; it's over 5%.
right.
And so, and then also you volatility adjust that. So even if the S&P 500 were to return 6%, if you had to have a lot of volatility to get that 6% compared to 5%, no brainer investment, the risk reward I think favors things like T-bills or tips at
Mm,
the current time, at least in terms of portfolio weightings percentages.
During his address at the 2023 World Economic Outlook, IMF Director Pierre-Olivier Goerens urged the U.S. government to reconsider its fiscal approach, particularly in light of persistent inflation and elevated interest rates. Goerens expressed particular concern about the United States, where fiscal deficits have significantly worsened in 2023. He emphasized that fiscal policy in the U.S. should not exacerbate the economic cycle, especially in the current stage of the inflation cycle, marked by lower growth, higher interest rates, and limited fiscal flexibility. Structural reforms of the appropriate kind at the right time have become imperative, and this is no longer an issue that can be ignored or postponed. According to Alden's assessments, this problem is likely to endure for at least the remainder of this decade and possibly extend into the early 2030s. In her recent newsletter, Alden stressed the importance of maintaining a level-headed perspective and not succumbing to excessive pessimism about our prospects, even in the face of a potentially unstable financial system, including at the sovereign level of developed nations. She acknowledged that discussions about these challenges can come across as bearish and even ominous, but she emphasized that significant monetary changes have occurred throughout history, and the system can reset itself and evolve. While the period of transition can be disruptive, the outcome ultimately depends on collective efforts. Alden remained optimistic about assets like Bitcoin and gold, noting that she has a favorable long-term outlook for them due to the expected fiscal challenges ahead. She also expressed her preference for various assets, including treasury bills, tips, select real estate, and specific equities. Acknowledging the financial complexities of the past few years, Alden suggested that the coming decade would likely continue to present unprecedented challenges. She concluded by noting that although we live in interesting times, life continues, and she invited readers to share their thoughts on Alden's outlook and the state of the US and global economies in the comments section. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.